Enron Corporation's collapse hurt many people. MF Global's bankruptcy hurt thousands more. The stock market's drop in 2008 forced many people to change their retirement plans. Now Europe is in financial trouble, and the United States is struggling to get out of its many troubles. What is a hard-working person to do? This short video will show you how to avoid these kinds of losses while safely accumulating great profits. You will see how 5 basic investing keys can lead to your success. We are all familiar with the proverb, "Don't put all your eggs in one basket." Dropping the basket will break all the eggs. Placing each egg in a different basket is analogous to being diversified. There is more risk of losing one egg, but less risk of losing all of them. In finance, an example of an undiversified portfolio is to hold only one stock. This is risky. It is not unusual for a single stock to drop 50% or more in a short period. The last few years have provided too many examples. Money management is considered by many investing professionals to be the most important factor for investing success. It is one of the pillars for survival. You need to know how much you can risk with any investment. You also need to know when to hold them and when to fold them. Another rule we generally follow is to never trade against the market, whether it's moving up or down. I'll show you a strategy that is built around this idea. I'll also show you 2 more that contradict it. Enter slowly and exit fast is a widely recognized but often ignored principle. We only invest our money when all factors indicate a high probability of success. However, we exit quickly, especially when we have a profit, to make sure we keep it. One principle you may not be familiar with is to minimize exposure of your funds to risk. Things constantly happen around the world that usually adversely affect our market. In my systems, our assets are protected by spending most of our time safely in cash. Now, almost everyone is aware of and concerned with recent market affecting events. Enron, Desert Storm, Bosnia, 9/11, too big to fail. The list is almost without limit. Many people have invested their money in really good stocks, only to watch them plummet in value when some disaster happens. What happens to your investment after you read, "The CEO has just sold 60,000 shares," or "The SEC is investigating the chief financial officer for embezzling or fraud"? In 2008, even safe havens like the utility Duke Energy dropped by 40%. We diversify across market segments representing, for example, large companies, small-sized companies, technology, and emerging markets. While one market segment may be losing, another may be gaining. Diversification reduces the effect of any losses on our investment equity. In one of our portfolios, we diversify by investing in a basket of stocks. Experience reveals a repeating pattern. After each big run-up in profit, it seems there is a comparably big pullback. Many investment managers recommend adding to a position as it's rising in value. In contrast, I believe it is better to reduce a position as profit rises. When timed properly, this reduces the amount of profit given back. Plus, it minimizes risk by capturing profit while also returning invested funds to cash. It's a balancing act. I do not want to have closed my position while it is rising. At the same time, I need to recognize the possibility of a dramatic pullback after a bubble. This is the basis of my money management and probably the most important key to my success. There is an old adage among investing professionals that the trend is your friend. Another similar comment is, do not fight the tape. These comments are basically saying that it is best to buy stocks when the market is going up and sell stocks when the market is going down. How often have we heard pundits recommending this is the time to enter? After all, how much further can a market fall? Believing in bottoms is very risky. Generally, there is a very good reason why a particular stock or the market is falling. I make sure I'm investing in the same direction as the market. Sadly, in 2008, many were invested in mutual funds, believing their assets would be protected by their fund managers. During that crisis, millions of investors saw their assets cut in half. Few fund managers protected their clients by going into cash. Unfortunately, the bylaws of most investment funds require them to follow the buy and hold strategy. They are prevented from closing their holdings and going safely to cash when the market is dropping. I do not enter the market easily. I require a lot of different factors to be aligned, indicating a high probability for a successful trade. I do not accept tips from outsiders. However, I sell investments quickly and safely go to cash. My goal is to protect profits along with equity. Personally, I'm a lousy stock picker. My choices for exits are even worse. I've developed an automated system that determines my entries and exits based on past history. Any one of the many money management rules will cause me to close an investment in favor of cash. Instead of looking for occasional home runs, I prefer to find many singles. The best way to avoid loss is by being protected on the sidelines safely in cash. I do not get into the market very often. When I do not stay very long. My automated system calculates when is the best time to make profits. Funds are invested less than 1/5 of the time. The rest of the time, I'm in cash. These principles have been combined to make my investing systems successful. My different strategies have been tested through down markets, such as the drop in 2008, and in up markets, such as in 2010. Strategy testing showed outstanding results for each of the systems. Losses tended to be small, infrequent, and rarely consecutive. Over 70% of the trades were profitable. The sum of the profits were more than 4 times the sum of the losses. 2 of the 3 strategies were in cash over 75% of the time. The third was designed to trade monthly. I focused on these 5 key fundamental principles while building these 3 unique investment systems. The portfolio builder strategy aims at investing in major market indices in both bull and bear market. This is done by choosing select exchange-traded funds, better known as ETFs. All these trades are permitted in IRAs. Security Builder is a conservative strategy that invests in gold and silver ETFs only when they are rising in price. Occasionally, when in neither gold nor silver, it invests in a basket of rising stocks. Pairs Builder is an aggressive strategy employing options. Monthly trades are designed around highly correlated and inversely correlated with pairs of ETFs. Portfolio Builder is a 3-part investment strategy that combines an unusual market timer with a select group of market indices and our grab the cash and dash money management. It trades large cap, mid cap, and small cap ETFs, as well as ETFs for emerging markets and energy. Portfolio Builder has consistently outperformed the S&P 500, the benchmark rarely achieved by most mutual funds. Security Builder was designed from the start to be a conservative strategy for trading gold and silver with either unleveraged or leveraged ETFs. In general, the price of gold and silver moves independently from the market. This strategy looks for market patterns that have a high probability of success. Its entries are cautious, especially because these trades are often against the direction of the market. Money management still adheres to the take the cash and dash philosophy. You are safely in cash most of the time, so your market risk is low. More importantly, this equates to low exposure of your equity to risk. When not invested in either gold or silver, it trades a basket of stocks that have moved independently of the market. Pairs Builder initially grew out of my investigation into the chart shown here. It represents a Rorschach pattern often found with inversely correlated ETFs. The study produced an extraordinarily profitable strategy with a very high percent of winning trades. Later, this option strategy was extended to trade correlated pairs of ETFs, even with better success. Because there is high risk associated with option trading, only a small portion of equity should ever be applied to this strategy. My monthly pairs trades are planned to last up to a month. Each time a pairs trade is put on, it is designed to have a 25% to 40% profit monthly. I help subscribers with a newsletter that leads them through all my trades. The newsletter clearly tells customers when to enter, when to exit, what portion to exit, and how to do it. Each of the three systems has a separate newsletter. My support is personal. Questions are encouraged. They help me to improve the service. My blogs, videos, and webinars further help educate subscribers. Whatever your trading style, I believe one of these systems will help you achieve success with your investments. Thank you for watching this video. Please visit my website, Grab the Cash and Dash. There you will find videos that explain my strategies in greater detail, along with their exceptional testing performance.